Have you ever seen a chart that seems to be forming a specific shape, and you're left wondering what it all means? Well, today we're going to break down one of the most crucial chart patterns in trading, the head and shoulders pattern. Now, some of you might be familiar with the basic idea, but let's go back to first principles. A chart pattern is essentially a repeating arrangement of price movements that provide clues about future price action. Think of it like a roadmap that helps us navigate the markets. The head and shoulders pattern is a classic example of a chart pattern, and it's formed by three key components: a left shoulder, a head, and a right shoulder. Imagine you're at an amusement park, and you're on a roller coaster ride. The left shoulder is like the first drop, the head is like the crest of the hill you're about to go down, and the right shoulder is like the second drop. Now, let's talk about the actual pattern. The head and shoulders pattern starts with a left shoulder, which is a peak in price. It's followed by a drop to a trough, which is what we call the head. This trough is usually the lowest point of the pattern. However, beginners often make the mistake of thinking that the head is just the lowest point of the whole pattern, but it's actually more complex. The head often shows two lower highs, which can be seen as a failure in the price movement of this area. The head can also be wider and deeper than the shoulders. After that, the price moves back up to form the right shoulder, which is another peak. To illustrate this, let's use a simple example. Suppose the price of a stock starts at 100, and it rallies to 120, the left shoulder. Then, it drops to 90, the head, but notice that along the way, it makes a higher high at 100, then a lower high at 98, and then it drops to the trough at 90. This too-high failure is a warning sign for an impending downtrend. As the price recovers, it forms a new peak at 110, the right shoulder. If the pattern is formed correctly, the price will break below the right shoulder support level, which is in this case around 105,107, and move downward. Here's the thing, though beginners often make a few critical mistakes. One of the most common is getting too excited about the pattern and entering a trade too early. Remember, patience is key. Wait for the price to break below the right shoulder support before entering a trade. It's essential to set your stop loss at the right shoulder support, or even above it, so that you can limit your losses if the price rebounds. Another common mistake is not waiting for the pattern to complete fully. You see, the head and shoulders pattern often forms in the context of an already existing downtrend. If the stock is in a downtrend and the pattern starts to form, you should wait for the price to close below the right shoulder support for a confirmed buy signal. If you're unsure, always err on the side of caution and avoid entering a trade. Mistakes also happen when the pattern is incomplete or doesn't follow the expected shape. It's crucial to ensure that each component, left shoulder, head, and right shoulder, is complete and follows the pattern's structure. The head and shoulders pattern needs a clear and sharp breakdown from the right shoulder to be considered valid. Let's move on to the practical exercise. For your homework, download the demo chart from your trading platform, or use a paper trading journal, and let's work through this step by step. Identify the left shoulder, the head, and the right shoulder. When looking at the left shoulder, ask yourself, was the price a peak in this area? Did it drop significantly after the left shoulder peak? When looking at the head, ask yourself, did the price make two lower highs along the way? Is the head wider and deeper than the right shoulder? When looking at the right shoulder, ask yourself, does the price rebound from the same level as the left shoulder? Are the two shoulders roughly the same height? Make sure you understand the pattern's structure and wait for the price to break below the right shoulder support before considering a trade. If the price doesn't break below the right shoulder, it might be a sign that the pattern is invalid. Keep in mind that trading always carries risk. You can lose money, and there's no guaranteed profit. Always trade with caution, and never risk capital that you can't afford to lose. Recap: the head and shoulders pattern consists of a left shoulder, a head, and a right shoulder. It's a strong reversal signal, and it's crucial to wait for the price to break below the right shoulder support before entering a trade. To be a successful trader, you also need to understand key concepts, such as risk management, and always be aware of the